Good morning and welcome to Edelweiss Money Connect, our podcast on book summaries on books that are worth their salt. In this podcast, we share the insights gathered from especially curated books featured in our Edelweiss Insights book summary section. They are also available for you to read on the Edelweiss Mutual Fund website. So sit back and enjoy these amazing books while you carry on with cooking, gardening, cleaning, working out, or any other activity.
When Warren Buffett says that a particular book is, and he quotes, by far the best book ever written on investing, unquote, then it definitely requires our attention. The Intelligent Investor, written by Benjamin Graham in 1949, is possibly the most important and influential value investing book ever written. A Bible for all investors, it made the concept of investing simple and easy to understand, so that even an ordinary investor could become an intelligent investor.
Also, don't forget the infamous Mr. Market that he created in the book and the concept of margin of safety that he introduced.
Right. There are some gifted people who are born intelligent, cut from a different cloth. Their ideas have changed the world. Then, the rest of us. However, there is no need to lose hope. An interesting thing that the book points out is that intelligence is more about character than the brain, which means that we can all teach ourselves to become intelligent investors. The first step is to understand the difference between investing and speculating. If you're taking stock tips from the chaiwala under your office building, then you are definitely speculating. However, if you're doing a thorough analysis, determining the risk return from the stock, and are focused on long-term instead of short-term price movements, then you are investing and are most likely an intelligent investor. Always remember that investing is not about beating others at their game. It's about controlling yourself at your own game. Most investors fail because they pay too much attention to what the stock market is doing currently.
Now let's talk about the famous Mr. Market and why knowing and understanding him is the next step towards becoming an intelligent investor. Many of you must have heard the term frenemy. Somebody who's a friend but can also be an enemy? Well, Mr. Market is something like that. Imagine that you own a few shares in a private business. Assume that these shares cost you around $1,000. However, you're not alone in this business. You have a partner called Mr. Market. He's a very obliging partner. Every day he will tell you the value of your shares. He will also offer to buy your shares or tell you that you should buy more shares. As you listen to him, sometimes his idea of value will make sense to you. Often, on the other hand, it might seem that Mr. Market has let his enthusiasm or his fears run away with him. At these times, the value he proposes would seem a little short of silly. Now, here's a question for you. Do you think that an intelligent investor will let Mr. Market's daily communication influence his view of the value of $1,000 interest in the enterprise?
Most likely not.
Correct. An intelligent investor would listen to Mr. Market only when he agrees with him or wants to trade with him. At all other times, he would simply ignore Mr. Market and form his own views of the value of his holdings based on research and analysis.
I get it. Mr. Market is simply the stock market that witnesses volatility and sharp price movements regularly. As an intelligent investor, we must ignore these short-term movements and focus on the long-term fundamentals of the company.
Bingo! You got it. Now moving on to the third step. All investments carry risk. In order to become an intelligent investor, you must be able to determine the risk of your investment and the risk that you can take. To determine the amount of risk that you can take, you must consider factors related to your marital status, current and expected future responsibilities, the stability of your income, your spending needs, and your investments.
These factors will tell you the amount of risk that you can take. If you take less risk, then you can consider yourself a defensive investor. On the other hand, if you take more risk, then you can consider yourself an enterprising investor.
Yes, and the investment strategy that you adopt will depend on the type of investor that you are. If you're a defensive investor, then you should divide your funds between high grade bonds and high grade common stocks.
Further, in bear markets, you should consider increasing the percentage allocation to common stocks, since you will be able to pick up stocks at a bargain price. Conversely, the common stock component should be reduced to below 50% when the market level has become dangerously high. Also, investing in investment funds is more suitable for the defensive investor.
Now, moving on to the entrepreneurial investor. If you are an entrepreneurial investor, then you can consider having a higher proportion of common stocks in your portfolio. Here's a list of 5 things that you can follow while constructing a portfolio. First, always enter the market during periods of depression and exit in the advanced stages of a boom. Second, always be careful when buying growth stocks. Third, always look for bargains. Usually, bargains are created in the aftermath of disappointing results or due to protracted neglect or unpopularity. Fourth, buy into special situations. For example, buying potential acquisitions target, usually smaller companies. Fifth, consider buying a relatively unpopular large company.
Now, coming to the most important concept of the book and perhaps of investing, the concept of margin of safety.
In stock investing, margin of safety is the difference between the intrinsic value of the company and the price we pay to purchase it. The idea is to pay a sufficiently low price for the stock relative to the actual or intrinsic value of the stock. The difference between the purchase price and the intrinsic value is the margin of safety. The greater the margin of safety, the more leeway we have for things to go bad before we lose money. If the future is as we expect it to be, the profits generated from that investment will also be much higher.
One of the main reasons why investors lose money is that they buy low quality stocks at times of favorable business conditions without a margin of safety. As a result, when markets turn, these stocks are the first witness sharp downward price corrections. Now that we have understood the concept of margin of safety, let us discuss its key component, diversification.
We all know that we must not put all our eggs in one basket. However, when it comes to applying this to investing, we often tend to ignore this advice. The odds would be with us when we only invest in individual stocks with a large enough margin of safety. While some stocks will live up to our expectations, many others will not. Diversification can increase the benefits of margin of safety. A diversified portfolio has a higher probability of generating above average returns.
And the last thing to remember is the impact of inflation. Inflation is real and it erodes our purchasing power over time. What this means is that cash is a terrible investment. We need to make use of the cash to get more cash.
That's right. We need to invest cash to beat inflation. Investors often overlook the importance of inflation. Psychologists call this the money illusion. For example, if we receive a 2% raise in salary in a year when inflation runs at 4%, we will most certainly feel better than if we take a 2% pay cut during a year when inflation is zero. Yet, both changes in the above mentioned scenarios leave us in a virtually identical position, which is 2% worse after inflation. However, investing in stocks for the long term and REITs can help investors guard their earnings or investment returns from the ill effects of inflation.
To summarize the key takeaways from the book, first, everyone can become an intelligent investor by applying a few key principles and investing in a disciplined manner. Second, it is important to ignore the short-term market fluctuations and invest for the long term by focusing on the fundamental value of your investment. Third, based on the level of risk you can take, you will be categorized into a defensive investor or an enterprising investor. This will influence the type of investments you can make. Fourth, always buy stocks with an adequate margin of safety. That is, the price that you pay for it should be sufficiently lower than its true fundamental value. Last, build a diversified portfolio to enhance the return potential of your portfolio while mitigating overall risk. Always remember, investment is most intelligent when it is most businesslike. When we buy a stock, we become an owner of the company.
Often, investors find it challenging to judiciously incorporate and follow these rules in their portfolio building. Does that mean that they can never become intelligent investors? Absolutely not. Such investors can consider investing in mutual funds that follow many of these rules. Mutual funds can help you create intelligent portfolios. For example, most equity mutual fund schemes invest from a long-term perspective and do a holistic analysis of a company before investing in it. By investing through mutual funds, investors can build diversified portfolios with an adequate margin of safety and a potential for compelling long-term returns. To listen to more such interesting book summaries, don't forget to tune in to the next episode of our Money Konnect podcast, where we will be giving you a flavor of how the millionaire next door lives. Further, these podcasts are also available on the Edelweiss Mutual Fund website, Spotify, and Google Podcasts for you to listen, learn, and enjoy as per your convenience. For further information on one-time KYC process, list of SEBI-registered mutual funds, and redressal of complaints, visit our website. An investor education and awareness initiative of Edelweiss Mutual Fund.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.